welcome back. You're watching Stockwatch with me, Juliette Televi, and joining us to take your stock-related questions this evening are Nader from Benguela Global Fund Managers and Devin Shutte from the Nader Group. If you'd like to send questions, please email stockwatch@bdtv.co.za or via SMS on 41392. Grant, Devin, good evening to you both. Nice to see you there. It wasn't a great day for the overall market, but one share in particular had a pretty good day, notwithstanding a 3.2 billion rand loss, and that was Pick n Pay. And there's a couple of questions on it, and you would have viewers would have seen the interviews that Nader did with Sean Summers, so I might as well launch straight into the questions. One viewer says, poor results, yes. Family relinquished control and the share's up 6.6%. End of an era. Do we believe in their plan? Would you enter now or still prefer ShopRite? And another viewer is somewhat more expressive about the family. He says, with the Ackermans now relinquishing their obnoxious stranglehold on Pick n Pay, could we see some near-term bounce or some improvement in the Pick n Pay share price? Grant, if I may start with you. Firstly, do you think the plan as sketched out is worth backing?
Yeah, I think it looks a lot more interesting now. First, I think it's already bounced. If you remember from last week's trading update, it's up 20% before today. Then you add today's move as well. And I think what people are looking for is some clarity. First of all, as long as that family controls it, the Ackermans, you're not sure about how much conviction there is in the strategic plans, how much likelihood of implementation there is and making hard choices. So that is a positive. There's a bit of visibility. You're seeing Boxer with continued momentum, Clothing with good momentum. They're taking the hard knocks, writing things down. I mean, what I didn't like was there's still a 2 to 3 year plan before they're profitable on a cash flow basis from the Pick n Pay corporate. But I think they're doing all the right things. I think if you wanted to buy it now, there's a higher risk level involved. If you wait until the rights issue, I think when you see what discount it's at and you'll get a look at the balance sheet after that, I think it's looking interesting, and it's going to get more interesting post the rights issue. A little safer, I would say, but overall, I think they're doing the right thing.
Yeah. Yeah, Devin, on that note, if you're not a Pick n Pay shareholder now, would it be the savvier thing to do to wait until the rights issue has passed? I suppose that's the first question. The second question, okay, I've got 3 questions. The second question is, as a Pick n Pay shareholder, if you were one now, would you follow your rights? And would you be prepared to stay in something that is a 2 to 3 year turnaround story, or a medium-term turnaround story, as I said in the results announcement?
Yeah, Juliette, difficult questions and no easy answers there. I tend to agree with Grant. I think if you're not a shareholder, to wait for that rights issue and see how dilutive it is. I think if you've been in the stock for a while, you've really got the bumps and bruises to prove it. It has had some short-term recovery, but yeah, it's if this is the bottom of Pick n Pay, or if we've been through the bottom, that's the key question you've got to answer yourself. And does it look better from here? Does the raising of capital from the rights issue and the unbundling of Boxer, which I think gives them about 10 billion rand in capital to really shore up the balance sheets and pay down that debt pile, what does the business look like after there? And yeah, I think it is going to take patient capital. I don't think this is an overnight success story once that debt's been paid, just simply because the business model that they had been employing for so many years was faulty, and they've now got to really change strategy, take the new leadership team under Sean and really execute effectively. And there's a lot of risk that they don't do that. So I don't think it's obvious that this is a clean turnaround, but I think all the ingredients are there. And yeah, it's one we're going to be watching very closely for the execution of what has been a very difficult hole for them to dig themselves out of.
Just a last question here. Would either of you actually just circumvent Pick n Pay entirely and buy into Boxer when it lists? You don't have any of the legacy issues. You've got a strong, growing competitor to ShopRite. Would that be the simpler play?
I think it depends on your risk appetite. I think the Pick n Pay play is a riskier play. It's going to be highly volatile. You might make a lot of money, but it's also not clear that you'll make any money, and that things might get worse. So, I think depending on the Boxer looks like a good business. I think that will be a successful listing, and I think it will be a good business. You can certainly wait for that and take a lower risk approach. In the interim, if you want a bit of excitement in your life, maybe have a look at Pick n Pay. We don't hold it yet. There's not enough clarity of outcome. and there's still a lot of risk in that. So it depends on what you're in for. That would be my. I think you can do it either way, depending on your view and your risk appetite.
Yeah. Last comment from there, from you, Devin, with regard to Boxer.
Yeah, Gillette, I like the business model. I think it will depend on what the valuation it lists at. It's incredibly cash generative, and genuine growth coming from that chain there. So yeah, we like it. We definitely going to be looking more into it, and 100% a lot of a less risky proposition than buying the Pick n Pay group.
Okay. Then what about Barloworld? So before we talk general markets, stock specific, it came out with results today, which weren't brilliant. And a cautionary announcement, which I think has intrigued some people. One of the viewers says, can someone please shed some light regarding the Barloworld cautionary? Devin, do you have any inkling as to what this might be about?
Yeah, I haven't. I didn't have a chance to look fully into what that one was. I mean, unfortunately, those results I think were quite soft, and yeah, I think the SA macro is really hurting them, isn't it? There's just this very lackluster growth environment, inflation high, interest rates really hurting them on that big equipment. Ingrain also was fairly soft for these results. They tried to do all the right things, pay down the debt. The Mongolian operations looked like they had a good period, but yeah, tough going at the moment. And yeah, let's hope that as rates start to come down, and if we get an economic turnaround, that they'll be in the forefront to benefit from that.
Grant, what did you think of the results, and do you think it's a business that they're buying, a business they're selling, or do you think they themselves are a takeover target? I feel that it's not the latter, because the wording would have been different, I imagine.
So this is just like a renewal of cautionary, and when this cautionary first came out, there was a significant rally in the stock price. Without having any more information, my assumption was they're going to sell Ingrain or somehow dilute that, because that has been a very poor acquisition. It continues to be a poor acquisition. I'm hoping they're not growing that business and making an acquisition there, because I think that will be seen negatively. So that's my speculation, something around that. As for the results, they were fairly poor. As Devin said, it was only, I think, Mongolia that delivered growth in earnings and margin and the like. The rest are struggling, and the commodity cycle seems to be turning, but I didn't get a warm fuzzy from them in terms of the outlook and the sort of order book, etc. So not a great set of numbers. I think the cautionary is what people are holding on for, that there's going to be a positive catalyst there.
Okay, and maybe the positive catalyst has already taken place, as you said. If you look at the lows to which Barloworld dipped in, and from which it subsequently rallied. Okay. Generally speaking, a viewer says most of the sectors on the market were in the red today. We closed about 1/3% down. Is this pre-election? Are these pre-election jitters? What if elections are a non-event? The status quo remains. Will we see a bounce back? Grant, what do you think?
I think so. I think this is pre-election jitters. We've seen a lot of buying over the past 4-6 weeks in this run-up to election. The rand has been stronger. We've had no load shedding. There's been a little bit of optimism around, and I think I'm not that surprised to see a little bit of profit-taking or pressure on mostly the SA-facing sectors as well. You're seeing it in the banks and the retailers, which are the most sensitive to a bad outcome. I think the election outcome most likely is fairly benign, and I think that will be received positively. So that's where I am on that.
Devin, how about you? I mean, the rand had a real fillip, but I think it was upended by the Fed minutes that just seemed to, I suppose, or clarify that there are going to be fewer rate cuts than had been hoped for, because the rand was on a tear until that put a screeching halt to that run in the currency. Or do you think the rand is maybe poised for a further recovery come Wednesday?
Look, I think, Julita, all around there is caution going into something like elections. The event risk, although the probability of getting a really market negative outcome is small, it's still there, and that kind of keeps investors on the sideline a bit and not getting ahead of themselves. They have been dipping their toe into the market, and as you say, we've been seeing our market and the currency appreciate as a result. But I definitely think market is waiting for some more certainty. The rand itself has been driven by some domestic factors. I think increasingly there's the sense that Lesesha Kanyako may cut rates ahead of the Fed, that we might decouple with the ECB and the BOE. That looks like that is building as inflation starts to come under control. And then I think also, we've seen just some flows coming in from, I guess, the Anglo Billiton deal, or the expectation of that. So I think overall it's been more positive than I expected leading up to elections, but definitely still the unknown. Our base case is for business as usual, a non-event. The day comes and goes, and then we're back to a life in South Africa and really having to do the hard work on the ground.
Just the correlation between load shedding and the rand, it seemed quite entrenched a few months ago, and I was wondering if the relative strength that you've seen in the currency has been partly as a result of the lack of load shedding, or maybe you might have expected to strengthen further were it not for pre-election anxieties. So in other words, whether the rand actually could rally to 1750, Wayne McCurry was saying that is a possible level for the currency. Grant, I don't know if that's maybe overly optimistic.
No, I think these currencies have a way of overshooting on both sides. So I think that is possible. I don't think originally the load shedding was driving the rand, especially when it was just for a short period of time. But we've now gone over 60 days with zero load shedding. I think there's a little skepticism around whether it's election related and whether we'll see load shedding next week or not. But assuming there is a much better outcome in terms of load shedding, even if there is some, but a lot less than last year, that's going to improve the outlook for GDP. I mean, there's a lot of pain in the GDP number baked in because of load shedding. So already the outcomes this year have been far better than last year. Yeah. There might be a GDP surprise. You add that to potentially an improving rates outlook, certainly a confidence outlook, businesses better placed. I think the rand could continue to strengthen once the uncertainty of the election is out of the way, because even if it's low probability, markets don't like uncertainty. So yeah, I'm fairly optimistic.
Yeah. There was a question that came through on Investec, which released results last week. The viewer says, I like the Investec results and outlook. They have an insulated consumer and give a global hedge. The share, where it is at the moment, is plus as cum dividend. Would you enter it now, or would it go to 114 Rand, the viewer says? In other words, would you look for a lower level for the share to enter it? Devin, what do you think?
Look, I mean, I agree with the viewer's comments. It's really executed very well on its niche target market. I think they have been insulated from kind of the macroeconomic volatility that people at the lower end of the LSMs have been subjected to. I do like the private banking across the UK and the USA. That gives them some nice diversification there. It's a bank where return on equity is decent, margins are good. Question: Would you enter this one here? Yeah, it's a tough one. I mean, I think it's had a pretty decent run, although it's been sideways for about 6 months. I don't think the valuations look particularly demanding. I think it's trading at about its book value. And so yeah, we think it offers something that maybe some of the other more domestic listed banks don't. It's very interesting to us, and yeah, one we think is attractive around current levels.
Grant, how about you? I mean, if it's flattened a bit, I suppose that was to be expected because Investec had this phenomenal rebound. I suppose it had been actually, and you forget that it had been under the cosh for so long, and in the last 2 years, it's really come back into its own. At this point, though, would you buy it or would you wait a bit?
No, I think you can start buying it. Perhaps if you're not sure about timing, buy some now and buy some in a month or two, either high or low. But I certainly think they're moving in the right direction. The management focus is on the right things. They're trying to drive their ROE. They have been a very lazy balance sheet for a long time, and that's changed. There's a definite improvement in the business, the way they're managing their capital, the operating momentum. I think it's a good story. I think it'll stay a good story for a couple of years to come if they continue in this vein. So you never know when the right time to buy something is. Do the numbers make sense? Is it the valuation fair? It looks like it to me, so I would make a start.
Okay, yeah, you don't necessarily get everything at the perfect entry price. Okay, so maybe feed your purchases in. There's a question on the Dipula Income Fund. I don't know if it's a very small company. I'm not sure if either of you follow it, but the viewer says it's got a dividend, 24.5 cents. Coronation owns 25%. Is this a good buy now? Value accretive with a good dividend yield? Do either of you look at this one?
Gillette, so not my side. I can't add value there.
Alas.
I'm afraid I'm in the same boat. Just pay attention to the liquidity. I'm not sure how big your investment size is. Some of these property stocks are not that liquid. In fact, most of them. And if there's a 25% big brother holding it as well, you may find there's not a lot of liquidity, which just makes it quite tricky when you need to get in and out. But yeah, other than that, I can't add too much value there.
Yes, you're both value non-accretive at this point, I have to say. So I shall move on. Is Remgro a buy? Devin, is this one that you would consider, or have you gone cold on investment holding companies?
No, not cold on investment holding companies. Remgro not as attractive as it used to be. I will say that. I think the portfolio doesn't have as many moving parts as it used to. So I think there's possibly less attractiveness for us. That being said, you're still getting exposure to high quality assets. I'm just looking at what the share has done over the last year, and yeah, potentially that's what's being reflected there. So yeah, I mean, I think it's one we used to follow quite closely, but yeah, now that you've really just got that, a very kind of lean down portfolio, I think it's of less interest. But as with everything and these investment holding companies, we'll look at the private assets and make a call on those there.
Grant, I mean, I feel like we've been writing about Remgro for a few years now. Mark Hossenfuss and I wrote a cover story about 18 months ago. And you sort of expect, is now Remgro's moment? And the whole thesis was that you wouldn't be able to replicate a Remgro portfolio by buying, various listed businesses as it had, and that Remgro would be the sole entry point into a vast array of unlisted companies that were great, and you had the central shareholder. But it just is not happening in terms of the share price performance. So it's a perennial frustration at this point.
Yeah, it really is. And there's a long history of unwillingness to unlock value. They haven't demonstrated a lot of value within the portfolio by unlocking and spinning off and realizing value for the investors to unlock that NAV. And they've taken that MediClinic, private. That's a good 30% of their NAV. And that's not a particularly exciting prospect other than the Rand hedge. I mean, hospitals are a tough space to operate. So that's a big chunk. Distel is a great asset, but it's not big enough in the scheme of, you're not really buying Distel if you buy Remgro. And they have some, what I think of average assets as well, with some good assets. And I don't see a clear path to unlocking any of that value. It's not a compelling dividend play. They don't have a lot of funds that they're bringing up. They're nurturing with a plan to list them in future to, like a private equity style listing to exit. So I don't really see anything too excited that they hold, anything too exciting that I want to own. That other than the discount, that's what the attraction is that there's a decent discount there. But how do you realize a discount? Well, I don't know. That's the question I have for management.
Yeah, and a question that they grapple with pretty much every 6 months and every AGM, and it's kind of unanswerable, it seems, at this point. Okay, so neither of you particularly fond
There's just a lack of activity in that direction, I would argue. I mean, you can talk about it, but what are you doing? Where's the action? So, yeah.
You don't have to just look at Remgro. There are other investment holding companies on the JSE. The one that is kind of unsung that we don't often speak about is Sabvest, which has done quite well. I don't know if either of you look at it.
It is so illiquid. I don't look at it. Over to you, Devin.
No, I mean that's the issue there, Grant. Is it is very difficult to get in and out of it, but it is much more compelling portfolio. We would argue. Also, got a good track record of divesting in certain of the businesses and buying into others and unlocking that value, as Grant said, that maybe Remgro as a kind of a bigger ship hasn't been able to do. So yeah, smaller holdings. It's got the ARB, which used to be listed. That's in there. Apex, SA Bias, those type of things have really been doing well for it. So I think we like the portfolio. There's also Rolf's. A lot of investors will remember that.
Yeah.
Metrofile in there. So it seems to make a lot more sense to us, and I think we rate the leadership team here. But yeah, I guess liquidity is going to be kind of your first port of call to check before jumping in here.
Okay. Then what about a share like Investec? I know it's little. And the viewer says, what's the deal with this counter? It's halved despite trading at a low PE multiple. We did discuss it briefly last week. Grant, I don't know if you look at it. They seem to have a stock issue, and yeah, I'm not sure if you can shed any more light there.
Like, unfortunately, it's not my night in that regard of these little stocks. But what I will note is that it is very cheap. But the fact that it's cheap and the fact that it's halved does not make it a buy. There are a lot of cheap stocks in South Africa right now. There are a lot of value, and there's a lot of value traps. So you really need to do your homework and make sure that there's some prospects for growth within the business if you want to unlock and realize that value. That's all I'll say. I don't know the business well enough to go further than that. But I think it's trading on 3.5 times earnings, which looks cheap. But there's usually a reason for that.
Yeah. Devin, any further insight?
Look, not on Investec specifically, but I think if you look at the smaller companies that are listed on the JSE, they've just been almost in an impossible space where there's just one, been a really difficult macro environment. Two, there's just been no risk appetite, and as a result, liquidity has dried up, and these management teams have actually been kind of scratching their heads saying, what can we do to attract buying coming back in? And the answer is very little until the investor appetite comes back. I think you're just going to see them languish at these very low single-digit PEs, massive dividend yields, and I think increasingly we may start to see management teams buy them out, take them private, because it just almost doesn't make sense to be listed at the moment.
Yeah. All right. Well, where would you venture with your cash? Grant, going back to you, what's your stock pick this evening?
So mine is, I'm not sure how well known it is, but it's a global US-based insurer called Kinsale Capital, and they focus on a niche of it's called excess and supply. So they focus on insuring the area where not a lot of insurance is. There's not a lot of standardized insurance, so it's quite unique. They've got a very robust business model, and they use a lot of analytics and data in their pricing. They've probably got one of the best claims ratios of all the insurers in the world at around 75%. It's a real consistent compounder. It's one of those that it just churns year in, year out, superior returns relative to the peer group. So it's a great little opportunity. It's a great business, and I think it's one worth owning.
Gosh, you had to scour the world for that. So that's a really nifty and interesting proposition. Devin, how about you?
Gillette, one we've chatted about before, going east, it's the China Internet ETF, code KWEB. And really what you're doing here is you're getting an ETF that gives you exposure to the leading Chinese tech companies. So you've got Alibaba, Tencent, JD, and the likes all in there. And I think why you would look at this is that there are clear signals that the Chinese economy is improving. It's got a long way to go, but the signs are there. It also looks like regulation is easing, sentiment is starting to improve there. And you're getting the Chinese market and tech, particularly from a comparative basis with US tech, at extremely attractive valuations. It's not correlated to how those other tech companies move, and the fundamentals are there. So we think, despite what is going to be a noisy geopolitical landscape with the US elections coming in, we think this is a very compelling buying opportunity into China, and the sharp end of the stick there is tech.
Okay. Gents, thanks for your insights, and thanks for two intriguing suggestions. Appreciate it. Grant Nader is from Benguela Global Fund Managers, and Devin Shutte is from the Robert Group. And up next we have The Close. Do stay with us.